Hi everyone, Mike Riley with Gaining Altitude, and it is Friday at the end of another long week of very volatile activity in the investment markets. And I thought it was a good opportunity to just remind all the folks that watch my videos that volatility is a natural part of the investment cycle. And there's really four things to keep in mind about that volatility. The first is on timing. So no one can really time the market when it's going to go up and when it's going to go down. If that really was the case, there would be a lot more people that would be making a lot more money. But even the pros don't know when it's going to go up and when it's going to go down. We can make predictions about trends based on international activities and political situations and what's happening with interest rates. But more often than not, we just can't predict that today is going to be a day where markets are going to go up or markets are going to go down. So if we really have short-term needs, that is, I need the money in a week or a month or even a year, trying to plan a time when it would be a good opportunity to invest is virtually impossible, and maybe it would be just best to sit in cash. The second is that it is short-term. Volatility up and down tends to take place over a relatively narrow time frame. If the blue line here represents activity in the marketplace over the last 50 years, the times when it's down are usually much shorter than the times when it's going up. In other words, the bear market is a lot shorter than the bull market. So we're in a very volatile time right now with interest rates coming out of COVID. There may be another wave of COVID coming. We've got war in Europe that continues, supply chain issues, inflation. All of those things are combining to make the market very volatile. But it will end, and it'll probably end within this calendar year, unless something else comes up. We just don't know. But generally, the trends towards longer periods of growth those are longer times than the short ones. Number three is diversification. And that really means having things in your portfolio which tend to offset drops from particular investments. So one way to do that is to increase the amount of fixed income instruments inside your portfolio. Those are things like bonds, GICs, mortgage-backed funds. They tend to have a lot less peak and valley. They're not quite as influenced as some of the equities are. So the green line here would represent a portfolio that has a broader diversification within it. So you'll see that it's going up and down in concert with the other line, but it doesn't have as high peaks, and the valleys aren't quite as low either. Also diversificating within your equity portfolio, so not simply looking at sectors like natural resources or IT or healthcare, and then having a broad diversification geographically. So not everything in Canada, not everything in the United States, having more broad investments globally as well. So we're not confined to just one level of currency or one political system. And finally, staying in. So stay. During times of volatility, it's very natural for people to want to pull back, cash out, and sit and wait until things are better. The challenge with that is we won't know when things are better until they are better, and by the time they are better, the opportunities for gains have already happened. If you'd like to send me an email, I've got an article that's excellent about what happens if you miss the 10 best days in the marketplace. So that means that if the 10 best days that have occurred, if you weren't invested during those, what the losses or what your lack of opportunity would have been. And we just don't know when those days are. There have been some excellent days since January on the investment markets. We didn't know when they were going to happen, and they just happened. And by the time the day is finished, it's too late to have capitalized. So when we look at markets, when there are investments, the time frame between when the valley occurs and the time frame between gains and losses. So if you invested here, by the time you were here, there's a fairly large opportunity for growth, even though there were some valleys in the middle. One other thing that you can do too is dollar cost average. So that's a fifth free tip. By making regular contributions, regardless of whether the market's going up and down. So if you're investing $200 every biweekly, then sometimes you're going to be buying at the top, but sometimes you're going to be buying units when they're on sale. Statistically, over a long period of time, that level of dollar cost averaging has a better rate of return than trying to pick and choose when you think that it's a good opportunity to invest. So I hope this has been helpful. If you have any concerns about what's happening to your investments or whether now is a good time to start investing, I'd be happy to speak with you. Mike Riley, always here helping you with gaining altitude financial, helping you gain altitude and gain financial confidence.